Good evening, Garage Gang. If you're stepping in tonight, clean your damn boots because this market didn't just show up, it kicked the door off the hinges, crashed through the living room, flipped the furniture, ripped the Wi Fi out like it owed money, and punted your dog just for making eye contact. And guess what? It's me again. Because when the smoke cleared and the rookies were still screaming into their phones, I'm the one left standing, steering wheel in my hand, car completely gone. So before we drop into this beautiful hellscape of a week, smash that like, hit the follow, and share this with your fellow degenerates or your uncle who still calls it the Bitcoin. Now strap in, because what happened next wasn't a dip, it was a full-blown market collapse. Let's get straight to the part where the entire market went sideways. Bitcoin didn't wobble. It fell straight through the damn floor. We're talking a violent slam down into the $93,900 zone. Not a wick, not a mood swing, a trapdoor. You could feel it. Exchanges lagging, order books turning into skeletons, stops going off like fireworks at a funeral. Liquidations blasting the tape like shotgun shells against steel. And when BTC hit that 93.9K crater, miners stumbled. Worse than anything we've seen this cycle. Rigs flickering, hash slipping, mining treasuries cracking open like emergency glass. Below miner cost? That's not philosophy. That's not conviction. That's survival. Below miner cost is sell coins or shut down operations. That's it. And while retail was panic selling their future into red candles, two killers stayed calm. Cardone and Saylor. Cardone stacking monthly with cash flow, not emotion, not fear. 935 units ordered, almost there. And Saylor, Bitcoin Magazine dropped the hammer. MicroStrategy bought Bitcoin every day this week. While the entire market was crying over 93.9K, Saylor was filling the damn cart. No panic, no hesitation. This is the split you need burned into your brain. The crowd panicked at the floor. The kings bought the floor. And the floor wasn't the real story, the reaction to the floor was. And while Bitcoin was face down on the pavement after that brutal slam into $93,900, the rest of the financial world didn't walk in like heroes. It limped in like it just got off a 12-hour flight in cheap shoes. Let's break down what the hell was happening outside the crypto swamp, because this wasn't just a bad day. This was the entire macro engine misfiring in real time. And I'm spelling every number out so even the rookies in the back of the garage can truly see the scale of this thing. Over in TradFi, the landscape looked like a late cycle bar fight. Chairs flying, bottles breaking, and nobody entirely sure who swung first. But if you slow the chaos down, frame by frame, the winners and losers become painfully clear. And trust me, there aren't many winners. The only true outlier, the only thing still climbing the mountain while everything else slides down, was artificial intelligence. A basket of 38 AI-linked stocks pumped about 15.7% in the third quarter, while the broader market barely coughed up 7.7%. That means AI didn't outperform. It doubled the entire market. And sitting at the center of this supercycle like a glowing nuclear core is NVIDIA, the first $4 trillion company in human history. That's not a stock. That's a continent. Right behind AI's throne, you've got utilities. Yes, the boring stuff, ripping 16.83% this year. When utilities become the star athlete, it means institutions are sprinting towards safety like rats toward the last life raft. Communication services looked like it was on a tear with a 28.6% gain this year. But that's a house standing on stilts. 2 or 3 mega caps dragging the rest by their teeth. Autos managed about 6.2% this month. Retail wholesale pulled off roughly 2%. Cute numbers, sure, but don't confuse motion with leadership. The truth is simple. AI is leading. Utilities are defending. Everything else is pretending. Now slide your vision back into crypto, and the lights go out. The entire space shifted into a defensive retreat. Not risk off, retreat. Every shiny narrative got thrown into the furnace. Real world assets, down. Gaming, down. Layer 1s, down. Layer 2s, down. Memes, annihilated. DeFi, bleeding out. The only asset that didn't disintegrate on contact, Bitcoin, but only because it bled slower. Bitcoin dominance ripped back towards 60%, the highest level since early 2021. And in the past 24 hours, Bitcoin down 3.4%, Ethereum down 6.7%, Solana down around 5%. That's not leadership. That's you sank slower. Now, let's talk about fear, the real kind. The crypto fear and greed index crashed into the basement at 15 to 16, which is even lower than the fear levels during the FTX collapse, where we bottomed around 20. Long-term holders, the monks who swear they'll never sell, dumped roughly 815,000 Bitcoin in 30 days. That's about $79 billion thrown back into circulation. Spot Bitcoin ETFs, they bled out around $2.6 billion over 5 weeks. The worst day alone saw $870 million fly out the door. This was after institutions tried to buy the dip earlier in the week with $524 million, only to immediately regret it and hit the panic button. Leverage vaporized. More than $1.1 billion in Bitcoin longs liquidated instantly. Open interest cratered from a peak near $94 billion, and funding rates flipped decisively negative. This is what a full capitulation stack looks like. Sentiment, institutions, long-term holders, leverage, miners, all snapping at the same time like the floor giving out. And miners, they were the last domino. Bitcoin sliced under the miner cost band, that $94,000 to $96,000 zone. And when it printed 93,900, miners didn't get philosophical. They got practical. Below cost of production, miners have only 2 buttons on the dashboard: sell coins or shut down machines. There is no third option. And this week, many of them hit the sell button. Meanwhile, everything macro tightened at the exact worst moment. The Treasury refilled its general account to roughly $962 billion, sucking liquidity out of the entire system. The Bank of Japan shrank its balance sheet around 7.7% year over year. Global stealth tightening. And because of the 6-week US government shutdown, the October CPI and PPI reports never arrived, meaning the market is literally flying blind. No inflation data, no updates, no direction. The Fed, a group that claims to be data dependent, now has no new data and is forced to rely on September's 3% CPI numbers and flawed nowcasts. When you're blind, you grab the controls tighter and pray. That's what the Fed did. December rate cut odds dropped below 50%. The legendary Fed put evaporated. So now you've got AI as the only true growth engine, utilities as the only real defensive shield, Bitcoin as the only crypto asset with relative strength, Ethereum bleeding mindshare, Solana and XRP sitting on a regulatory landmine, miners stressed, ETF flows bleeding, fear maxed, liquidity draining, and every trader on earth flying blind. But there were 2 men, 2 killers, who didn't flinch at a single red candle. Grant Cardone, stacking Bitcoin with cash flow, and Michael Saylor, buying Bitcoin every single day this week. While the crowd panicked, those 2 quietly accumulated the future. And that tells you everything you need to know about this market. If you thought Bitcoin falling through the floor was the whole story, you're dead wrong. That was just the opening slap. Because the moment BTC face planted into 93,900, the entire crypto narrative structure started smoking like a blown transformer. Every story people were clinging to this year, every narrative, every news cycle, every this time it's different pitch, all of it got dragged into the street and stomped. Real world assets, frozen. No inflows. Narrative paused, possibly for months. Gaming tokens down bad. Only the ones with actual players even pretended to hold up. DeFi bleeding out. Not because fundamentals are broken, but because there is no fresh capital left to anchor anything. Layer 1s, most of them are in traction. Layer 2s, holding on by dental floss. Memes obliterated the moment ETF outflows started. The entire altcoin ecosystem shifted into one direction: retreat. Capital sprinted out of the casino and hid behind the only thing it still barely trusts: Bitcoin. That's why Bitcoin dominance is banging on the door of 60%, the highest since early 2021. It's not because Bitcoin is strong, it's because everything else is weaker. And now the whole fragile, wounded, bleeding crypto ecosystem is sitting under a live grenade waiting for the pin to be pulled. The SEC's final decision deadline for the Franklin Templeton Spot Solana and Spot XRP ETFs. This isn't just another headline. This is a detonator. Look around. Risk-off regime, global liquidity tightening, miners stressed, ETF outflows accelerating, retail terrified, institutions exiting, Fed flying blind, macro sitting on the brink. Ask yourself, in this environment, what possible incentive does the SEC have to approve high beta altcoin ETFs? Let me say it slow, Garage Gang, so it lands. Base case, denial. Denial is not a disappointment. It's a trigger, a catalyst for the final flush. Solana already dropped about 5% in 24 hours. Its DeFi total value locked is down almost 8% in 7 days. The structure is fragile. Support levels are weak. Capital is fleeing. A denial hits this market like a sledgehammer. Sol loses its floor. XRP loses its narrative. Alts take another leg down. Bitcoin gets dragged into the shockwave. The final minor capitulation gets finished. The washout candle under 94,000 becomes real. But there's a tail scenario, and it's violent. If the SEC surprises and approves anything tonight, we get a face-melting short squeeze in a terrified, liquidity-starved market. People who've been shorting alts will get teleported into the sun. Bitcoin rips. AI tokens spike. Every candle prints like a heart attack monitor. Not because the fundamentals changed, but because there is no liquidity, and fin markets move like wild animals. Either way, approve or deny. This decision doesn't come in quietly. And while the entire crypto complex sits on a powder keg, global headlines were pouring gasoline on every single sector. Tariffs cut on beef and coffee, trying to calm grocery rage before inflation numbers return. A Ukrainian drone and missile attack halted oil exports at Russia's Novorossiysk port, roughly 2% of global supply disrupted. Oil traders twitching like nervous snipers. Berkshire shifted $4.3 billion from Apple into Alphabet. Old money putting bigger chips on AI rails. Tesla flexed that FSD supervised mode makes drivers 7 times less likely to crash, fueling the AI transport narrative. Anthropic revealed Claude helped catch a state-level cyber espionage attempt targeting around 30 organizations. AI is now a weapon and a shield. Google rolled out AI that shops for you, calls stores for you, explains deals for you, and ghost texts you like an efficient ex. This is not a feature. This is the death of friction. DeepMind drops SEMA 2, an agent that navigates 3D worlds with human-like reasoning. Soon, your gaming buddy might out-strategize you in real life. Waymo rolled freeway autonomy to 3 cities. Robot taxis doing 70 miles an hour while you snack in the back seat. Tavis launched emotional AI avatars, digital beings that can look you in the eyes and read your soul, like a therapist who charges by the minute. This week wasn't random. It was coordinated chaos. It was convergence. And in the middle of all that mayhem, while miners were puking supply, while ETFs bled billions, while altcoins collapsed, while TradFi limped in half-conscious, while the Fed stared into the abyss without CPI data, 2 men didn't flinch: Grant Cardone and Michael Saylor. Cardone stacking Bitcoin every month with cash flow. Every level, every cycle, no emotion. 935 units ordered. Almost there. Saylor buying Bitcoin every single day this week. No hesitation, no excuses, no fear. While everyone else panicked, they accumulated. That's not speculation. That's empire building. And that's why you're here. Because this is the point in the movie where everyone else freezes and the garage gang wakes up. And while crypto and TradFi were getting dragged across the parking lot this week, there was one sector that didn't flinch, didn't wobble, didn't blink: artificial intelligence. AI didn't hold up. AI thrived while everything else bled out. The same AI equity basket that pumped 15.7% in the third quarter is still outpacing the entire market by a mile. And NVIDIA, the first $4 trillion mega giant, is basically the gravitational core of global markets now. But the real AI action wasn't in stocks. It was in the war zone. Because if you weren't paying attention, this is what happened. Claude caught a whole state-level cyber espionage op before it detonated. Yeah, not meme-level AI, not make-me-a-cupcake recipe AI. I'm talking about nation-state hacking units trying to use Claude code to infiltrate around 30 organizations worldwide. Anthropic traced the signatures, flagged the weird behavior, shut the accounts down, and then publicly said with a straight face, "We have high confidence this was a Chinese-affiliated group." That is not tech news. That is digital warfare. AI is now both the weapon and the shield. And while Claude was busy stopping an espionage op, the rest of the AI world dropped bombs of their own. Google rolled out AI that shops for you, calls stores for you, checks inventory for you, applies coupons for you, and then texts you the results. We're not talking about search. We're talking about a full-blown personal agent that handles errands like a digital butler. Then DeepMind walked in like, "Hold my beer." They dropped SEMA 2, a virtual world agent that can navigate 3D rooms, follow multi-step instructions, interpret scenes, solve puzzles, and adapt across multiple engines without being retrained. That's not an upgrade. That's embodied intelligence taking its first steps. Your next gaming partner, your next co-pilot, your next robot brain, it's already being trained. Then Tavis pops in with their emotional AI avatars, digital personalities that can see you, respond to you, and hold conversations with actual emotional intelligence. And Waymo? They unlocked freeway-level autonomy in Phoenix, San Francisco, and Los Angeles. Robo-taxis now doing 70 miles an hour while you sit in the back eating chips. This isn't hype. This isn't concepts. This is AI rewiring daily life in real time. And while all this was happening, Roby, our AI Intel Ops agent, summed it up perfectly. AI can shop, talk, negotiate, navigate, and ghost you faster than your ex. That's the truth. While crypto was crashing, AI was ascending. While TradFi was limping, AI was expanding. While miners were puking coins, AI was building the next decade. This is why the AI narrative in crypto, RNDR, FET, Tau, is still the strongest thematic line left standing. It's plugged directly into the only sector that's actually growing, while everything else collapses. AI is not a trend. AI is not a narrative. AI is not a moment. AI is the new financial gravity. And now we move into the weekend storm. And listen, when I say the next 48 hours matter, understand something. The next 48 hours is the weekend. That means the suits go home. The charts go feral. Asia gets the first swing. Liquidity dries up like a puddle in the desert. And every move hits twice as hard because nobody is around to catch the fall. Weekends in crypto aren't normal time. They're the Badlands, the outlaw zone. The part of the movie where the sheriff goes missing and the bandits start cooking dynamite. If ETF outflows slow tonight, the weekend chop will feel like controlled turbulence. If miners regain footing, you'll see stabilization under the surface. But if Asia opens with fear, if the SEC grenade goes off, if whispers turn into panic and thinner weekend liquidity, then this isn't a pullback. It becomes the last flush, the kind that only happens when the tourists go to sleep and the real killers are still awake, watching. This is the weekend where weak hands evaporate and strong hands sharpen their knives. This is where narratives break and convictions get exposed. This is where the market decides who walks into Monday as a survivor and who crawls in as a cautionary tale. And normally, I'd have Lulu on guard duty all weekend, using her pig math to sniff out the next move. But we let her clack out early. She earned it. She took one look at this market, snorted, dumped her chart on the floor, and waddled off like, y'all can have this one. So here's what we do. We don't force anything. We don't chase. We don't panic. We observe. The next 48 hours are the quiet before the next chapter, the coil before the snap, the inhale before the punch. And Garage Gang, we'll be back in the garage Monday. Full crew, full energy, full analysis. And this weekend, don't you dare miss the Token Teardowns. We've got 2 hot projects on the lift, strapped in, engines exposed, ready for the full garage treatment. This week tried to break you, and here you are. Awake, informed, dangerous, and still standing. Good, because the weekend storm is coming. Engines hot, safety